If you would have decided to invest in HDFC Bank 10 years ago, so roughly let's say here at 700 rupees, then let's see that if the stock price doubles every 5 years. Hi everyone, welcome to today's video. So let me start today's video by stating out a very useful and an important fact. And the fact is that if you go and speak with any rich person in the world, literally any rich person in the world, they will all have one quality which is common amongst them. That quality is that they are very good at mota math. Now, what is mota math? Mota math simply means that they are very clear about how they are going to make money and how much money they have to make. Number two, they'll be very clear about where to invest it and what type of investment style makes sense for them. Third, they will be very clear about how much of money they would like to spend and on what things. These are three questions around which our personal finance journey also revolves. We keep on trying to get answers around the questions like how much money should I be saving? How much money should I be earning? How much money should I be spending? So I'm going to break down three very simple, easy to understand rules for you on this video that will help you understand this mota math and become wealthy over time. So super important, super interesting, super fun video. So please give it a like and we'll get started. Also, a very quick shout out to Upgrad. It is an excellent upskilling platform. If you want to get rich in your life, the best way, and I keep on speaking about this on my channel, the best way to do it is that you need to amplify your skills. I have curated a list of courses that I like from Upgrad. You can go and check it out on the description box. So let us get the video started. So the first rule is called as the Crorepati rule, or you can call it 15-15-15 rule. I have touched upon this rule on some of my earlier videos, but let me speak about this rule in a holistic manner now. So let me demonstrate this point by taking you to a SIP calculator and show you the power of this rule. So 15-15-15 simply says that if you invest monthly investment 15,000 at an expected return per annum of 15% for a period of 15 years, then you end up making this much amount of money, which is in excess of 1 crore. So let me play around with these numbers to help you illustrate some of the key points that you need to take away from this rule. So the first key thing is that your time period is of a lot of value. For example, if you do not change any parameters, you just change the time horizon to just 5 years, right? Instead of 15, just 5 years, you only end up making total value of 13.45 lakhs. So your portfolio shrinks a lot. If you take this to 25 years, so instead of 15, 25 years, then what is the impact? So you will see that the impact is 4.92 crores. So all the parameters same. 15 years, you make roughly 1 CR. 25 years, you make 4.92 CR. 5 years, you only make 13.5 lakhs. So the first key takeaway is that time horizon is very important and you must start figuring out your financial goals as early as possible because it gives you something called as compounding benefits. What are compounding benefits? I just explained you. Let's move on to second key takeaway. The second key takeaway is that this rate of return is very important. Rate of return is very important. Here we are assuming that we will be able to grow our wealth by 15%. So let me break this number down and let me help you clarify how easy or difficult it is to grow your wealth by 15%. The first sub point that you need to remember here is that if you take a look at the last 10-year CAGR of Nifty 50, so if you just literally do passive investing, you go and invest in Nifty 50 index fund, you would have roughly made 12.2% as CAGR. So close to 15%. If you do direct equity investing, then your returns will really depend on your skill set. People make negative returns also and people make 40% returns also. So it really comes down to your skill set. But the point I'm trying to drive home is that it is not too difficult to make this 15%. A counter argument that I keep on getting is that Akshat, if it is so easy to make 15%, why is it that mutual fund managers, they are not able to grow their wealth at 15%? This is an entire discussion in itself, but let me give you a very quick synopsis of that. First and foremost, majority of the mutual fund managers, they do not put their own money in their own mutual funds. That's point A. Number two, mutual fund managers play it safe. Now, what is meant by playing safe? So imagine this, that who are the customers of mutual fund? The customers of mutual fund are people who are not very active in terms of direct equity investing. So they feel that, hey, if I give my money to an expert, that expert will at least grow my money more than the FD rate. So that becomes the target for mutual fund managers. Because think about it this way, that what is the best alternate for you? For example, if you don't know direct equity investing, your only option is to either go and give your money to mutual fund managers or do a fixed deposit. These are your primary options. If you're doing fixed deposit, then you are making 5-6%. But if your mutual fund manager is giving you a return of 8, 9, 10%, then you will be happy with it. Why? Because you are getting more than the FD. Now imagine a scenario that 1 year, some mutual fund manager gives you a return of 20%, right? Next year, what will be your expectation? Your expectation will be that, hey, give me more return than 20%, otherwise I am pulling my money out. Why? Because you might have gotten used to seeing that 20% return. So therefore, mutual fund industry is a safe industry. Mutual fund managers, active mutual fund managers, even according to Mr. Warren Buffett, they are not able to generate more than the passive index return, which are more than 12.2% return. This is what the data tells us. This is not just me saying. If you do a little bit of digging, these are exactly the facts that you will be able to uncover. So coming back to the rule that I was explaining, so there are two very important concepts here. Number one is that time horizon, you need to be really aware of that. Number two, you must invest in instruments that are roughly giving you 15%. If you do that, you will be able to grow your wealth to a substantial level. Now, before moving on to the next point, let me elucidate the concept that this is not a very difficult thing to do. So the word of the day today is elucidate. Let me know what does that mean. Now, think about it this way, that it is not too difficult to save 15,000 rupees. If we cut our expenses here and there, start a side income, making this 15,000 is not too complex. You can definitely grow it at 12.2%. If you learn a little bit of stock investing, you can grow it at 15 also. So this is also not difficult. The only thing is that when do you decide to get started? Even if you're getting started at 35, you can still stay active in the stock market till the time you are 60. So that still gives you 25 years. Which is not a small time. You can still easily become crorepati. So that is the power of this 15-15-15 rule. Once you have figured out your goals and you have learned a little bit about money making, second rule comes about investing. That where is it that you should invest? And the primary question that people ask is that, Akshat, I want to double my money. Can you suggest some assets where I can make really quick returns? Or I'm a very low risk taker. I just want to invest in super safe assets. So taking either of these approaches might be bad. I'm saying might be bad. So for this, there is a rule called as rule of 72, which I will explain. Now, rule of 72 simply says that how much time does it take for you to double your money? If you take this number 72 and divide it by the return of the asset, for example, if we pick fixed deposit, the usual rate that fixed deposits pay is roughly 6%. 72 divided by 6, this gives you 12 years. So roughly it takes 12 years to double your money in fixed deposit. Let's pick one more example, that if you pick 72 and if you divide it by 15 based on rule of 15, how much time it would take for you to double your money? So it will roughly take you 4.8 years. Now you as an investor have to make a choice that, hey, should I just keep on doing my fixed deposits only, or should I take a little bit of risk and move to equity market? Similarly, there are a range of instruments where you can go and invest your money depending on your risk appetite. But the mota math tells us that if I'm picking an asset like fixed deposit, then it will take a lot of time for me to double my money. So there are three key takeaways from this rule: that you must avoid bad assets that have a very slow growth rate. For example, something like gold. Now I'm saying something controversial and a lot of people might start creating ruckus, but please try to look up the historic CAGR of gold. You will realize that it is roughly around 5 to 6%. So again, it will take you 12-13 years to double your money, whatever you're putting in gold. So it's a lot of time span and it does not help you. So ideally, you should take very little positions in something like gold. Second key takeaway is that what is a target that I should try to grow my money at? So a rough good target is roughly 15%. Now, why is that? Because think about it this way. If you start with a capital of 6 lakhs, you will double it in 5 years, it will become 12 lakhs. Then you will double it in another 5 years, it will become 24. Then you will double it again, it will become 48. Then you will double it again, it will become roughly 1 crore. So how many times you have to double it? 1, 2, 3, 4. So roughly in 18 to 20 years time, your money from 6 lakh will become 1 crore. That is the power of compounding and growing your money at a decent rate of 15%. So this is the target rate that you should keep in mind. Now comes the third and the most important point, which is that majority of your money should be in sensible things. Now you decide whatever is sensible. I have met a lot of people who will invest all their money in cryptocurrencies, or they will keep all their money in fixed deposits. Now, if this style of investing works for you, great. Nothing wrong with that. But bottom line is that you should be a balanced investor. You should take positions on a range of different assets and together it should give you 15% return. So that is the goal, right? So let me demonstrate it by giving a very specific example of a stock. Right now, there's a lot of noise about HDFC. Now, all of us are aware of HDFC. I'm not talking about HDFC Bank. I'm talking about the parent company HDFC, Housing Development Finance Corporation. So, a lot of people are getting panicked that Akshat, HDFC is falling, I'll go bankrupt, this, that. So, let us take a look at the numbers and try to figure out if something like HDFC is a sensible purchase decision or not, or should majority of your wealth be invested in similar stocks. This is not a stock advice, but I'm just using HDFC as an example. So, what helps a business grow? If you have to answer it in one word, it will be profits. If a business is profitable, it will grow. So let us very quickly take a look at the HDFC numbers, and you will see the net profits in rough 10 years have grown at a CAGR of 15%, right? And we discussed the 15% rule. Now let us also see if the price of the stock has also gone up. If you would have decided to invest in HDFC Bank 10 years ago, so roughly let's say here at 700 rupees, then let's see that if the stock price doubles every 5 years. In 2017, 2018, it should have roughly moved to 1300, 1400. So yes, it is moving to roughly 1250. So almost doubled. So then let's take a look at 1200 levels. Now let's take a look that if the stock price doubled by 2020, 2021. So 1200 and we are at 2400. So yes, it has doubled again. So what will be the scenario like if something like HDFC continues to churn out profits at a 15% CAGR? It will continue to double its stock price also every 4-5 years. That is a simple thing that we miss out on, and we keep on looking for really risky stocks, all that stuff. The point being that majority of your wealth should be invested in these type of sensible assets. Now, if you have set a target that I'm going to make 1 crore in 15 years. Second, I will invest it properly in good assets. Third thing is that how much money should I be spending now? And how much money should I be saving? Again, a simple rule here will be that you can follow the rule of 4% withdrawal. What is the philosophy and math behind it? Let me very quickly explain. So first and foremost, let's assume that you have 100 rupees, right? Now in India, the inflation is roughly 6%. Now you're withdrawing 4%. Why 4%? Because that's the 4% rule. And if you can grow your wealth at 10%, then this wealth of 100 rupees will stay the same. Why? Because you spent 6% due to inflation. You spent 4% in terms of your expenses, the money that you have withdrawn, but you are growing this 100 rupees at 10% rate. So you're not losing money per se. So this is a very oversimplified rule, because a lot of time people ask me that, Akshat, how much money should I be spending in a year? My salary is 1 crore. So you should be spending 4 lakhs if you want your 1 crore to stay intact. Now, there is a very important caveat here. The caveat being that you should not undertake lifestyle inflation. Now, what is lifestyle inflation? Lifestyle inflation simply means that if I'm using this phone, so I'm using Honor X phone. I genuinely have this phone and this is my primary phone. So if I'm using Honor X phone, then it should not happen that after 10 years, I start buying iPhones or a series of iPhones. By the way, I shoot my videos through iPhone 11. That is my work phone, so to say. But in personal life, I do not spend too much money on materialistic things. So back to the discussion that your lifestyle inflation, bigger house, bigger car, bigger phones, all that stuff should not happen. If you're following that simple principle, then this 4% rule works wonderfully well for you. Another key related question that I keep on getting is that, okay, how much money should I save in order to retire? Is there some formula there? Yes, there is a very good formula, and it was suggested by Mr. Money Mustache. So the formula is that if you are able to save 70% or more of your salary for a period of 10 years or more, without undertaking any lifestyle inflation, then you can retire. I'll repeat that again. If you are able to save 70% or more of your salary for a period of 10 years without undertaking lifestyle inflation, then you can retire today. So that's the formula. Now, please do not tell me that, hey, this is very difficult. Yes, of course, it is very difficult because you're talking about retirement and you're trying to retire by 30s, 35, 40s, etc. Then, of course, it's a difficult goal. No doubt about that. That's the formula. That's the target that you must keep in mind. So 3 simple rules that we studied. One was the Crorepati rule, which is 15-15-15 rule. The second key rule that we studied was the rule of 72, which directs you to invest in right set of assets. And third and final rule that we studied was the 4% withdrawal rule, which gives us a sense as to how much money we should be spending. But here is the bonus rule that if you want to get really wealthy, really rich, then the best way of doing it is through compounding your skills. The more skills that you have, the more money you can make. For example, if hypothetically speaking, today you are making 10 lakhs, but if you are able to 2x or 3x your skills, then 3 years or 4 years from now, you might be making 50 lakhs. So that gives you a lot of earning potential. So always be on a lookout for improving your earning potential. And the best way to do it is to upskill yourself, learn new skills. And Upgrad is a good platform. I've curated some list of courses. You can go check it out. Thank you so much, and I will see you tomorrow.